Welcome to Tax Break, a podcast on the tax law brought to you by Miller Chevalier. I'm Steve Dixon, a tax litigator with Miller Chevalier. As usual, I'm joined by my colleague, international tax and tax policy expert, Loren. And today we have with us another colleague joining us, tax legislation and policy specialist, Jorge Castro. So today we're going to discuss some elements of the congressional relief that's been passed in response to the coronavirus, and in particular some of the elements of the CARES Act, which is the sole provision that has business tax provisions in it. So as we've said before, the idea behind Tax Break is to provide our listeners with some perspective on select tax issues that we think are interesting. We want to go deeper than what's in the tax press, but stay sufficiently high level so our listeners can follow along without a copy of the regs, or in this case, the final public law in front of you. And as always, we'll start with a disclaimer. Tax Break is not intended to be legal advice, and you cannot rely on it as legal advice. Its content reflects only the thoughts and opinions of its hosts or guests. So, Jorge, I want to start by going back in time to sort of days before the virus and the pandemic. What did it look like? I mean, let's talk about the legislative climate for tax changes before the pandemic hit. What did 2020 look like? What were the prospects for legislative change?
So first let me say thank you very much to the both of you for having me here. I'm honored to be on your podcast. So to answer your question, Steve, so I think just judging on how 2019 transpired, the outlook for 2020 pre-COVID-19 was pretty limited. I think that at best, we were looking at perhaps one legislative vehicle that could include tax provisions sometime towards the end of the year. As the political landscape obviously is very active right now, and with the lead up to the November elections. So pre-COVID, I think that was going to consume a lot of the oxygen in the tax policy making world. So the opportunities were not going to be many, but obviously that has all changed, and that's been turned upside down.
And Loren, was there any reason to expect any changes or fixes to some of the TCJA provisions that changed the landscape so dramatically for taxpayers in 2020? And if so, what did taxpayers really want? What were they hoping for?
I think the hope was that there would be some space for TCJA modifications, but the prospect, to echo what Jorge said, was pretty limited. It's an election year. The changes around TCJA thus far have been rather contentious, with the Democrats generally saying that we didn't get to participate in the formulation of the bill, so we are not really in a position to discuss any kind of technical corrections or further modifications to provisions that were enacted in TCJA. We will get into some of the provisions of CARES in a little while, but we did see that one technical correction with respect to TCJA did make it into the Coronavirus Relief Act. So because the landscape has totally shifted, there may be room going forward, but before there was, I would say, little hope of getting any kind of TCJA modification or even technical correction.
And obviously all this changed dramatically when lockdown started and the pandemic began. So Jorge, when something, if you could talk a little bit based on your background, so when something like this happens, obviously this is unprecedented, but we do have disasters and other economic crises. What are some of the avenues that are available for Congress in coming up with ways to facilitate economic activity through the tax code?
Sure. So I think, in this scenario, while it's obviously the scope of the pandemic is pretty broad and the economic impact is unprecedented, I think, past its prologue, right? I think Congress looks to past packages that they've enacted, going back to Hurricane Katrina, to the Recovery Act, or back to the 2008 TARP bill that during the 2008 economic recession. So I think Congress, I think how it starts is it looks at past provisions in the tax code that were effective, right? And you've seen some of those provisions come back. Now, obviously, this pandemic and the economic impact is broad and significant and likely going to be very lengthy. So I would say looking at past provisions, but also dialing up whether it's refundability or the speed by which tax relief could be granted. I will say, I think right now the number one rule for Congress, when they enact tax legislation to combat the impact of the pandemic, is how do you inject cash into employers, individuals as fast as possible, right? How do you increase liquidity, right? Which is a significant challenge right now, right? Whether to the tax code or outside the tax code, that's the primary rule. And if you can make a convincing case to Congress that a sector that's impacted can get significant relief fast and quickly, I think that carries a premium in making those arguments in Congress. So I think you look at whether it's the ability to amend past tax returns to get refunds for tax years, whether you make tax credits refundable, whether you increase the deductibility of certain provisions. I think those are the avenues by which Congress, or I would say that's the prism typically, and the levers that's typically available.
And do you think that, is this basic principle of liquidity or getting cash into the economy, is that something that both parties try to use as leverage in hammering out what relief they'll make available?
I think that's right. I think, I think that's right. I think, both parties clearly have different, different constituencies, but also have different approaches by which sectors are the most impacted, right? Whether it's particular business sectors, whether it's particular individual family-oriented tax provisions, right? And you're seeing some of that right now play out, right? I think now, the first 4 bills have passed pretty quickly. The 5th bill, which is currently being considered or about to be considered, you're seeing that dynamic play out, right? Which are the most impacted sectors of the economy? How do you kind of get liquidity and relief as quickly as possible?
And so you mentioned 4 bills. So I'm sorry, Loren, go ahead.
No, that's okay. I was just going to ask, or make the observation rather, that really the shape of any provision depends on lawmakers' view of whether it's more efficient to inject liquidity at the business level or at the individual level, right? So that's the split that we see. Generally, the concept is, okay, if we make these business provisions more friendly, so you can accelerate deductions or have refundable business credits, that will kind of work its way into the employees of that business, or allow the business to reinvest in the economy directly, which will help people who are employed. Whereas other views are, maybe it's better to offer refundable credits directly to individuals, send out stimulus checks, those sorts of things to jumpstart the economy and also help people who may be negatively impacted, such that they've lost their job.
And I guess just one thing I would add, I agree with everything that Loren said. And I think it's one thing to add is that, typically, right, when Congress acts under normal times, right, there are typically revenue restraints, right? There's a budget cost that's attached. And so far that has not limited Congress's scope and how they've enacted tax proposals, right? So I think right now, the first question is, are you an impacted party? Are you an impacted sector, right? And then the second question becomes, well, if we enact X provision, how quickly would that relief reach the hands of those who need it most?
So do you think the deficit is going to continue to be a concern, or does it really depend on how long this pandemic lasts and whether or not, we have to kind of abandon prior considerations around deficit.
That's I think the $1 million question, right, Lauren? And but I think I do think right now
it's probably trillion, right?
That's right.
Several $1 trillion question.
Yeah, $1 trillion question. I think right now there seems to be very limited consideration, right? Those groups in Congress that would typically that would be the budget hawks, right? On both parties. They're pretty silent right now. But at some point, right, I think someone's gonna have to pay attention. Well, what's the deficit, right? And I've seen a few, groups in the private sector, typically, more along kind of the financial economic groups that I think that have started kind of trying to raise the flag, but I think so far it's falling kind of on deaf ears. And I think the argument is obviously is that right now we're still kind of economically not hit bottom yet, and I think that we're still kind of entering what could be a recession, depression, and I think we have to kind of pull any lever that we can, whether it's a tax code or through lending programs, and I think that's gonna be the main topic for a while.
And is the deficit the reason why there's been a cap on the PPP funds so far, the Paycheck Protection Plan program funds? I know that. I know that's been the criticism of that program, is that putting a ceiling on the funds has actually caused a bunch of businesses that could actually use the help to not get it. So.
That's a good question. I think it's, I guess, yes, that probably is a way to kind of have a check on the program, right? So that those businesses that could be perhaps less deserving, right? And then we've seen what the news has looked like lately around the PPP program. To kind of have a bit of a check on SBA, which is administering the program. So it's not just kind of an open checkbook, right? So the latest bill more than doubled the lending limit by $321 billion. So I suspect that's going to continue, a trend that's going to continue, but I don't see that's going to be just as an open checkbook.
Right. Well, let's move and talk about the act that I think is in our sphere, or at least hopefully in our listeners' sphere the most, which is the CARES Act, which is the act that actually has the business-related provisions. And I think we'll talk about a few of the provisions here. If we could start, I'd like to start with the employee retention credit. So Jorge, maybe you could tell us a little bit about how that works and what's going on with it currently.
Sure. So, the employee retention credit, which is one of the key tax provisions in the CARES Act, essentially is a refundable payroll tax credit for 50% of wages paid to employees during this pandemic, up to 10,000 wages. Essentially, that's it, right? So it's Congress's way of trying to provide a tax incentive to employers to retain their employees and keep them on the payroll. This provision I think is one of the more expensive provisions in tax provisions in the CARES Act. It's about $55 billion revenue score within the 10-year budget window. So it's pretty robust, and it's one of the obviously it's become one of the more popular provisions.
And I guess there's been some concerns raised about the interaction between that credit and taking deductions, right? Loren, maybe you could update us on sort of what's the back and forth been on that element of the credit.
Oh, there's been a lot of back and forth. So the service came out with a notice, I guess about a week ago, and said that, hey, under Um, well, I think the PPP and the business deductions are what are related. So
Right.
if you have receipt funds under the Paycheck Protection Program, there is a provision that allows those loan proceeds to be forgiven, and they will not be included in income, which is contrary to the general tax principle that forgiveness of indebtedness equals income. Fine. And so last week, the service came out with a notice and said, because of this forgiveness feature, we're going to deny ordinary and necessary business expense deductions to the extent that your loan is forgiven. And Congress came back. There was a letter, a bipartisan letter, that was written by the chairs of Finance and Ways and Means and joined by Wyden, I believe, that said, hey, this is contrary to our congressional intent. We, in fact, meant for taxpayers who take advantage of the PPP to also get the benefit of being able to take deductions. So it's kind of a twofold benefit, which is, admittedly contrary to general tax principles, but it was meant that it be that way. So you get a deduction and you get no income inclusion. And so they wrote the letter on the 5th of May this week, and then introduced a bill on the 6th that said the same thing, essentially, that overrode the notice and said you do get to take these deductions as well as have the loan forgiven if you meet the qualifications for forgiveness.
And hasn't there been indication from Treasury that they're likely to sort of retract the notice or
Yes.
go along with this congressional guidance?
Steve, you're psychic. You know what I'm going to say. So yesterday, Treasury wrote another letter and said, hey, you know what, we're gonna look at this again. They didn't promise that they would give the relief that the congressmen are seeking, but they did say they're going to take another look at it, that they're taking the letter under advisement, so to speak, and we'll see where they end up with them.
And this fast moving back and forth hasn't just been restricted to the PPP, right? There's also some issues with respect to the employee retention credit, right? And Congress has come out and expanded the notion of what counts as, I think it's health plan expenses. Jorge, do you know a little bit about this?
Yeah, that's right. I think it's, I think at first when the CARES Act was enacted, right, the understanding was that healthcare expenses were going to be included in the wage base. And then by way of FAQs, IRS and Treasury seemed to take opposite view, right? So that kind of had practitioners and employers scrambling. So that's another question. That's another area where Congress is looking to legislate and communicate to the IRS that no, our intent was to include healthcare expenses for purposes of the retention credit, right? And that's another dynamic where you're seeing, Secretary of Treasury and the IRS Commissioner kind of have a back and forth with policymakers, right? And I think it's to me it's as more of these gaps develop between Treasury and IRS and Congress, right, you're going to see mounting pressure on Congress to legislate again, right? And I think that's the dynamic that's likely going to occur. Right. But also I think it's also kind of a doing of, when obviously Congress was right in acting quickly and legislating fast, but when that happens, right, to this degree, you're going to see gaps and different interpretations from key policymakers.
And what's unique here is that because of the compressed timeline and the urgency of what's happening, we're seeing that sort of administrative, the executive branch back and forth with the legislative branch, but it's happening sort of, rather than it might happen through back channels and typical times, now it's just sort of happening publicly with letters going between Congress and Treasury.
Well, I think, I guess one thing to add to that is that, unfortunately, who's stuck in the middle is obviously taxpayers, right?
Right.
Taxpayers and the employees who would be the ultimate, beneficiaries, right? What are they supposed to rely on, right? They can't just rely on a congressional letter necessarily, or an FAQ even, right? I know that's I may be jumping ahead a little bit, but it's something that we're going to talk about. But at the end of the day, the FAQ doesn't always give certainty to an employer, right, under normal times. But obviously that's all they have, right? And us as practitioners, that's all we have. But I think to me that kind of underscores kind of that issue and that question mark, right? What are employers and practitioners are supposed to rely on?
But I just want to, so maybe this puts, I would say, undue pressure or excessive pressure on the service, because there's also no committee report or conference report, right? So this goes to the speed, and they're in the position of having to interpret, given, for example, the business deductions, they go on principles of exempt income that one would normally see in the charitable space, to come to the conclusion that these deductions shouldn't be allowed. And absent, any kind of writing that is contemporaneous with the bill actually passing, i.e. a committee report or a conference report,
Right.
they don't, they just have the law to go on, the existing law. So, it is a tough position to be in. And then to your point, Steve, we have the letters flying back and forth. And so we see the softening of the position with healthcare expenses being treated as qualifying wages, reconsideration of the business expense deduction, the availability of those deductions, and it is kind of an evolving landscape, even though they're moving forward.
Yeah, and it will be interesting. I mean, so FAQs obviously aren't authoritative interpretations of the statute by the IRS, and they're not meant to act like it's not meant to act like have the force of law, right? It's just an FAQ. But I do wonder whether there is an effect that these sort of accumulated FAQs and their subsequent retraction after Congress saying, no, you didn't actually understand what we intended here. We intended something else. I wonder if I wonder if there's a cumulative effect on the credibility of the IRS when they say this is the definitive interpretation in other guidance, right? In rulings and notices and other sub-regulatory guidance, whether there's an erosion there about what Congress intended. Now, obviously, this is an exceptional circumstance, and the lack of legislative history that you pointed out, Loren, is a very different factor. But
it is, but it's likely to continue. I don't think in the next bill there will be much in the way of legislative history either. So it'll be relevant for this set of guidance for sure, meaning coronavirus related relief.
Right.
But a good point is raised, right? Like kind of, what happens to the, I guess, shall we call it, reliability of the FAQ, right? I think it's, as you pointed out, Steve, I think it's the more often the IRS retreats from its initial FAQ position, right? What happens, what impact does it have? And I think you could see that come to a head, over time, that a taxpayer that takes a position opposite of the FAQ, right, could certainly make the argument that that FAQ wasn't necessarily what Congress intended in the statute. And I think, and then here, let us refer you to the 20 times the FAQs, were amended by the service, right? So I think that kind of goes to kind of what are employers and businesses supposed to rely on.
That's right. Yeah, and I think that it's certainly the case that if you have later disputes about the CARES Act in particular, and there's a history of the IRS getting it wrong, right? That's the kind of argument you could see in the future. Let's move on and talk about the NOL provisions in the CARES Act. And Loren, maybe you could just give us a little background on what happened with NOLs in TCJA and how the CARES Act aims to amend that.
Sure. So in TCJA, carry back of NOLs was abolished, and carry forward NOL relief, the deduction for NOLs would be limited to 80% of your taxable income. So no carryback, and there was a limit as to how much you could roll over into forward years. And to Jorge's point about injecting liquidity into the market, CARES Act said, hey, you know what? We're going to allow NOL carryback to 18, 19, and 20 for losses that are incurred this year because of coronavirus. So there is the carryback, and they also delayed the implementation of the 80% cap on carry forward until 2021. So you can take all of your NOLs all the way back to 18 if you are so inclined.
And the cutoff, I take it the cutoff there is driven by the rate differential with TCJA.
Well, the rate differential and also the implementation of the NOL rules, the harsher NOL rules. So those came into being in TCJA for tax years beginning on or after, I guess, December 22nd, I believe is when the bill passed. So generally forward. And
that's
so
that's the 80% limitation.
it's the 80% limitation for carry forward, and the abolishment of being able to carry back. So it's kind of dovetailing with the online, the harsher rules coming online within TCJA context. So those are the modifications to those provisions in CARES. So it allows carry back, and then the idea is that carrying back an NOL to 18 or 19, you've already filed your return, would give you less taxable income, so you're subject to a refund, and then taxpayers can take advantage of the quickie refund procedure to get the money faster.
Okay, and should we talk at all about the 163J changes that happen in the CARES Act as well?
Yeah. So those are similar concept. TCJA had made some modifications, significant modifications to 163J, and taxpayers are limited to, broadly speaking, deductibility of interest expense. That's 50% of their adjusted taxable income, or 30%, I'm sorry, of their adjusted taxable income. And then the CARES Act increased that limitation to 50%. So
again, another business friendly, but a cash flow,
right,
liquidity type change.
Yep.
Interesting. Yep. And one other provision I want to mention, just because it's near and dear to both me and Jorge, is the suspension of the aviation excise taxes. Jorge, you want to mention what the CARES Act did in that regard?
Sure. So I think, going back to Congress's principle of trying to assist most impacted sectors, obviously the aviation sector, right, primarily the airline sector, are taking a significant hit economically right now, right? That we've all read kind of the stories and kind of and the significant reduction of flights that are occurring. So essentially, the CARES Act suspends for this year, from the enactment of the CARES Act at the end of March through the end of this 2020 calendar year. It suspends the air transportation federal excise tax, the 7.5% ticket tax, essentially, on commercial aviation. Within that, you also suspend the 4.3%, the 4.3 cent fuel tax as well. So that's the main gist of it, and I think it's to provide relief for the sector that's being impacted.
Yeah, and to be clear, I mean, something that was slightly confusing when it was first enacted, but I think the joint committees come out and the IRS has come out and straightened this out, which is that it's something that applies to amounts actually paid during the excise tax period. So theoretically, if you are sure you're going somewhere in 2021, you want to buy the ticket now, go ahead, you get a 7.5% discount.
That's right, and that's obviously that follows the intent of Congress, right? Trying to spur economic activity again in the sector.
And then, so looking ahead, what can we expect in terms of further business tax changes that would come out of this crisis and the legislation in the wake of the crisis?
Who's going to start?
Go ahead. Whoever would like to.
Okay. International provisions are near and dear to my heart. So I would like to see some modifications of Section 250 for the FDII deduction, the interaction with the NOL provisions of CARES. There is a taxable income limitation in Section 250, which directly impacts the amount of your FDII deduction that's available to you. So that would be nice to have some modifications so that those provisions match up a little bit better. And the same in the context of 59 Cap A. So there is a base erosion percentage of your NOLs that figures into your modified taxable income calculation. And if the congressional intent was, and it was, to afford taxpayers a refund, if the result of you carrying back NOLs to years in which you had no BEAT liability, in fact, results in you having BEAT liability, the congressional intent has been frustrated. So it'd be nice to see some kind of modification to 59 Cap A. And it doesn't have to be, forever, but at least for the years in which the CARES Act modifications are in play, some modification to the 59 Cap A rules such that taking advantage of an NOL won't throw you into BEAT liability territory.
And Jorge, what do you see on the front? What do you think is going to come out of the next set of changes?
I think it's, I'll talk about a few provisions, but I think it's going to be a broad provision again, right? It's going to be fairly large. But I think, you could see, obviously, I think they're going to start with what changes do you make to the CARES Act to make the CARES Act tax provision more effective, right? And obviously, Loren has hinted at the interactions between the CARES Act tax provisions and the international provisions, which are important. You're already going to see activity around the tax issues around the PPP loan program, right? Which we've talked about. Also around the retention credit as well, right? Expanding the retention credit, whether it's a higher wage limit, and make that more robust. That's going to be on the table, and you've already seen kind of bipartisan action in Congress around the retention credit. So I suspect that's going to be a prime candidate for the fifth round, which I'll call it. There's continues to be talk about a payroll tax cut led by the president. He's obviously trumpeting that issue. There's also talk about additional, whether we call it, rebates or stimulus checks, more of that, and the proposal is kind of a run the spectrum. Increase in the earned income tax credit, child tax credit, expanding the charitable tax provisions in the CARES Act as well. That's going to be on the table. So it's going to be pretty broad. I think it's every indication from the House or in Congress is that they're going to try to start kind of considering a major bill that's supposed to be in the trillions again next week, as early as next week. So as folks know, the Senate's currently out of session now. House will come back next week, and the House is going to take the lead on the bill. And I think it's going to, whatever they put out, I think is going to set the marker. Obviously, they're going to have to negotiate with the White House and with the Senate, but I think it could lay the groundwork and set the marker for what the next bill looks like.
Great. And just for our listeners' benefit, it's May 8th today we're recording it. So next week is the week beginning the 11th. So, well, thank you both. I think this was really interesting and informative. As always, listeners, if you have questions or suggestions for future podcasts, you can send us an email at podcasts@milchev.com. That's podcasts, plural, at milchev.com. Loren, thank you as always. Jorge, it was wonderful to have you on today.
Thank you.
Thanks, everyone.